Well, they say nothing is certain but death and taxes. Well, this may not be true thanks to the 1031 exchange, at least about the tax part of it. Many of you have heard this term, and some of you have already done one, but how much do you really know? Did you know that a 1031 is a great strategy for both retirement planning and estate planning? Or that it's an underutilized tool for real estate investors who buy fixers or even build new construction? Okay, I can hear you. This sounds complicated. Do I really need to know this stuff? Well, the answer is a big fat yes. Remember, wealth is not just about how much you make, but how much you keep. A 1031 exchange is a similar concept to an IRA. It's a tax system that will allow you to keep more money and out of Uncle Sam's hands, but only if you follow the IRS rules, which can be complicated. Is this really important? Well, when you sell an investment property outright between federal and state capital gains tax, depreciation recapture, the possible 3.8% net investment income tax due, you may pay approximately 25 to 40% of your profits to the government that tax year. That's no bueno. So let's take a deep dive and learn about what this mysterious section of the tax code can do for you, when to use it, and how you can make it happen. Okay, first off, what is a 1031 exchange? The term 1031 exchange is defined under Section 1031 of the IRS Code. It allows a real estate investor to defer paying capital gains taxes on an investment property when it is sold, as long as another like-kind property is purchased with a profit gained by the sale of the first property within the following 6 months. By using all proceeds to purchase replacement property of at least equal value to the property you sold, you defer 100% of the capital gains tax and other taxes otherwise due. Cool. So, for example, perhaps you own a single-family residence in Los Angeles and you're sick and tired of the city rent control, county rent control, and now the California state rent control provisions. You heard Rock Real Estate talk about how you could sell your California SFR for $1 million and buy 3 or 4 SFRs in Orlando, Florida to rent out monthly or even nightly to Disney World tourists. So you want to sell your California property and buy properties in Florida, but you don't want to pay Uncle Sam 40% of your profit on the sale, which is a substantial amount of money. So what do? You hire an intermediary and you set up a 1031 exchange of properties. And I hate to be the bearer of bad news, but keep in mind this is a deferral, not a write-off. If you eventually cash out during your lifetime, then you will have to pay those huge capital gains taxes. But on the plus side, you can keep deferring for the rest of your life. And then what happens when your time on this planet is finally up? Well, it's a good thing I'm also an estate plan attorney because I've got good news. The 1031 exchange is also a great estate planning tool. If you are holding an investment property that had been part of a 1031 exchange, upon your death, your heirs get a stepped-up basis, which means that all of the built-in gain disappears upon your death. So the value of the property at the date of your death would pass through your estate to your heirs. So if they decide to sell the property for the same appraised value, there would be no capital gains tax due to be paid by your heirs. So what better way to help the future of your kids? Now here's a strategy for seniors. If you're contemplating retirement, you might want to purchase a replacement property in the area you plan to retire in. It'll give you the comfort of getting to know the local community, continued cash flow income while owning the investment property, and 3, the option in a few years for you to convert the property use from investment to personal. At that time, it could become a second home for you. Family and friends could visit there, or you could become your new permanent primary residence in retirement. What you do just need to follow the safe harbor rules set forth in Revenue Procedure 2008-16. Go look it up. So when should I do a 1031 exchange, you may ask? If you want to sell a rental property that is worth significantly more today than when you or the original owner purchased it, and unless your property is falling in the ocean, this is pretty much every property, then you want to do one of these things. Now, here's the capital gains rule in case you were wondering. When a property is sold, capital gains taxes are calculated based on the property's net adjusted basis, which reflects the property's original purchase price plus capital gains, capital improvements minus depreciation. And the size of the depreciation recaptured increases with time. So the longer you've owned the property, the higher the capital gains tax. That's called recapture of depreciation. All right, so what's the process here? The proceeds from the sale must be transferred to a qualified intermediary, which is similar to an escrow company in a normal transaction, rather than to the seller of the property. And the qualified intermediary transfers these funds when needed for the purchases. Now, there are 4 types of 1031 exchanges used by real estate investors. Number 1 is the simultaneous exchange, when the replacement property and the relinquished property close on the same day. This was the original exchange that the 1920s era law contemplated, and there are 3 types. Forget about it. This is for pros only. You're not going to be able to pull that off. So let's go to number 2. This is the delayed like-kind exchange, and this is by far the most common type of exchange. This occurs when the exchanger sells the original property before he acquires the replacement property. The exchanger is responsible for marketing his property, securing a buyer, and executing a sale and purchase agreement before the delayed exchange can be initiated. Then the exchanger must hire a qualified intermediary, which we'll talk about in a second, to initiate the sale of the relinquished property and hold the proceeds from the sale in a binding trust while the exchanger acquires like-kind property. The exchanger has a maximum of 45 days to identify replacement property and 180 days to complete the entire sale of their property. Now, number 3 is the reverse exchange, also known as a forward exchange, which occurs when you acquire a replacement property through an intermediary before you identified the property to be sold. You know, this is another one. I just leave this to the pros. Forget about it. So now, investors, pay attention. The construction improvement or built-to-suit exchange allows the replacement property to be renovated or newly constructed using the tax-deferred money to enhance the replacement property while it's being held by the intermediary for the remainder of the 180-day period. How cool is that? You didn't know about that? That's a good one. Okay, so far we assume that you, the investor, want to take full advantage of the 1031 exchange tax deferment. But what about downsizers or those that want or need to take some cash out of the sale? Well, it's time to shake your booty. Oh, wait a minute. I meant boot. For replacement property is of lesser value than the property sold, the difference is called boot, and that is taxable. If personal property or not like-kind property is used to complete the transaction, it's also boot and it is taxed. Now, mortgages are permissible on either side of the exchange, but if the mortgage on the replacement property is less than the mortgage on the property being sold, the difference is also boot and taxable. Regarding business entities, 1031 exchanges are carried out by a single taxpayer as one side of the transaction. So things need to be worked out if all members of a business entity do not want to participate in the 1031 exchange, as the entire business entity makes the exchange. Okay, let's sum up now. Here are some rules to remember for the typical 1031 exchange. 1. 1031 is only applicable for investment or business property. You can't do it on your home or your personal residence. Number 2. In general, the tax return name and the name appearing on the title of the property being sold must be the same on all properties. 3. The property owner has 45 calendar days post-closing of the first property to identify up to 3 potential properties of like kind. But there are exceptions that can allow any number of properties on either side of the exchange, including the 200% rule and the 95% rule, which we might be talking about later, but next video. Number 4, the replacement property must be received and the exchange completed no later than 180 days after the sale of the exchange property or the due date of the income tax return, with extensions, for the tax year in which the relinquished property was sold, whichever is earlier. 5, if the new property is of lesser value, we have a partial exchange and not 100% tax-free. Number 6, like-kind property is broadly defined according to its nature or characteristics, i.e. real property, not its quality or grade. So virtually any real property in U.S. territory should qualify. It has to be in the U.S. though. So there you have it, a section of the tax code originating in the 1920s that has been put to many good uses in the world of real estate, as you've just seen. It's incredible, huh? But it is imperative that investors consult with their tax and legal advisors. Do not try this at home. Do not. Not to mention, these laws are subject to change. President Biden has stated that his administration will consider eliminating 1031 exchanges entirely. So who knows? So always consult professionals when contemplating a 1031 exchange, and I'd be starting with my trusted CPA. Now, if you're a property owner and you thought this was an exciting video, just wait till you see our future article and video about using Delaware statutory trust real estate in your next 1031 exchange. That'll be a real humdinger. All right, well, stay tuned on Rock Real Estate. Check out our upcoming videos, and thanks for watching.